Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to do is talk about the equity markets, and the equity markets continue to correct. We take a step back, take a look at a long-term view. We still do have the NASDAQ below its 200-day moving average, which is a bad sign, but it is above its 12-month exponential moving average. If we were to make a decisive break below that 12-month exponential moving average, that may tell you that the short side may really be developing in this market. But right now we're at an inflection point. It's right above that level. The S&P 500 also just slightly below its 200-day moving average, but above its 12-month exponential moving average. Again, a little bit of an inflection point. The Dow Jones Industrial is above its 200-day, above the 12-month exponential average, acting the best. But we did see a breakdown in the Russell 2000 index, that's a small cap index, pretty much trading below its 12-month exponential moving average. So that's a bad sign. The transports are also below this level and also below its 200-day moving average. So all these things continue to kind of build up and tell us that this correction's kind of deteriorating. Things are getting a little bit worse. Now, if we take a look at leading growth stocks, what's going on with them, and things are also getting kind of bad. We saw Netflix now trading below its 200-day moving average, NVIDIA, another leading stock, trading below its 200-day moving average. Amazon acting pretty good, just below its 50-day but above its 200-day. Alphabet below its 200-day moving average. So we're starting to see a breakdown below these 200-day moving averages in these leading stocks. And that's kind of a bad sign, because earlier in the year in January, when the markets were breaking down and correcting, a lot of these stocks were still catching support at their 50-day or their 20-day moving average. And now we're kind of seeing quite a lot of deterioration. Furthermore, in a lot of growth stocks that are leading this market, a lot of the software stocks like the Trade Desk, Twilio, look like they're going to have a V-shaped type recovery just 2 weeks ago, and again, they couldn't hold these bounces and started to turn to the downside. And we're seeing that across the board. Now, in terms of leading industry groups, we're starting to see some defensive groups move to the forefront, like tobacco groups, food preparation groups, discount variety stores, retail auto parts. So when we start seeing groups like this moving to the forefront, again, it's telling us the market's not quite ready to continue the nice rally we've been enjoying. So, what's a trader to do? Well, if you're an aggressive trader, in our aggressive portfolios, we're 100% cash now. We've been getting into cash over the last few weeks, and even the few positions we're trying not really working out. Again, that tells you the market's not ready. If you're longer-term outlook, you could still be sitting in your favorite positions, but again, need to look out. And of course, there's always an anomaly. A stock like Apple, wouldn't even know the market's correcting, is hanging in there very well, sitting above the 220 level, acting very well. So you need to just put all these pieces of the puzzle together, realize the market's correcting. So we're kind of biased towards the short side. However, we could get a bounce off this 12-month exponential moving average. There always seems to be an inflection point. And if we do that, we could possibly rally. But if we break down, it's going to go short. So as always, let price and volume be your guide. This is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week.